Welcome to Value Vest Daily. You know, the AI gold rush is officially on, and in any gold rush, you can bet on a single miner, hoping they strike it rich, or you can own the company selling all the shovels and pickaxes. In this new era, semiconductors are the shovels. Now, trying to pick the one winning chip stock, that's a tough game. So today, we're looking at the whole toolkit, the four biggest semiconductor ETFs. We're going to break down SMH, SOXX, SOXQ, and the new specialist on the block, SMHX, to figure out which one really belongs at the core of your portfolio for the long haul.
So let's just get straight to the big idea here. You hear this phrase a lot, and for good reason. Just like oil powered the entire 20th century economy, semiconductors are the fuel for this one. They're not just little components anymore. They are the absolute foundational infrastructure for our modern world. I'm talking everything from the massive AI data centers to the phone in your pocket to the car in your driveway. This isn't just another tech trend, folks. This is a massive foundational shift in how our economy actually works. All right, here's our game plan for today. First, we're going to really wrap our heads around the incredible scale of this AI gold rush. Then we'll meet our four contenders, our ETFs, and put them in the ring for a head-to-head showdown on the numbers that matter. After that, we'll talk about why you should think of semis as a core holding, not just a quick trade. And then, the big moment. I'll give you our final verdict for 2026 and beyond. And of course, we'll finish up by covering the crucial risks you absolutely need to know about.
I mean, just look at this chart for a second. The gap in performance is, well, it's staggering. Over the past year, the top semiconductor ETFs have just exploded. We're talking returns of around 60%. Meanwhile, the broader S&P 500, a respectable 12%. But this isn't even in the same league. It just goes to show the immense power of being invested right at the heart of the AI revolution. The companies literally building the hardware for AI are playing a completely different game, and that's the powerful wave we're trying to ride. First up in the ring is SMH, the VanEck Semiconductor ETF. And this is the heavyweight champion, no doubt about it. It's the biggest, with over $44 billion in assets, and it's the most traded, which means it's super easy to get in and out of. It really hones in on the 25 largest US-listed semi companies, making it a really concentrated, powerful bet on the biggest names winning the AI race. It's the go-to for the big institutional funds for a reason. Next, we've got SOXX, the iShares Semiconductor ETF from BlackRock. Think of this one as the classic, the original gangster of the space. It's a little bit broader than SMH, tracking 30 companies, and it follows what's called the PHLX Semiconductor Index, which is basically the Dow Jones or the S&P 500 for the chip world. It's the industry standard. This gives it a more balanced feel, spreading the love and the risk across a few more companies. Okay, now this is where things get really interesting. Meet SOXQ from Invesco. This is the low-cost challenger. And here is the absolute key detail you need to remember. SOXQ tracks the exact same PHLX index as SOXX. You heard me right. You're getting exposure to the same 30 industry titans. So what's the difference? Well, it does it for a much, much lower fee. And for any of us who are investing for the long term, that cost saving is a massive advantage. And finally, we have our specialist, SMHX. This one's also from VanEck, but it's got a totally different angle. It focuses only on what we call fabless companies. So what does that mean? It means it only invests in the companies that design the chips. Think NVDA, think AMD, and it completely leaves out the companies that actually manufacture them, the foundries, like Taiwan Semiconductor. It's a pure play bet on the brains and the intellectual property of the operation. So, okay, we've met the contenders. Each one has its own unique flavor, its own strategy. But introductions only tell you so much, right? To find out who the real winner is for your portfolio, we've got to crunch the numbers. We need to compare them directly on the metrics that truly matter. So, let's get into the head-to-head showdown.
All right, round one, we're talking about cost. And for a long-term core holding, honestly, this might be the single most important round of them all. And folks, the winner here is not even close. It's a knockout. SOXQ comes in at just 0.19%. The other three, they're all huddled up around 0.35. Now, that might not sound like a huge deal, but that little difference of 0.16% compounded over 10, 15, 20 years, that can literally mean tens of thousands of extra dollars in your pocket. On cost, SOXQ is in a league of its own.
Round two is all about size and liquidity, which we measure by assets under management or AUM. And here SMH is the undisputed king of the jungle. At $44 billion, it is an absolute behemoth. Now, why does that matter?
Well, if you're a massive hedge fund trying to move hundreds of millions of dollars at once, you need that deep liquidity. But for pretty much any individual investor, you and me, SOXQ's $1 billion in assets is more than enough to get the job done easily. All right, let's put it all together on one screen and see the whole story. We already know SOXQ is the cheapest and SMH is the biggest. Now, let's look at that one-year return. SMH is the leader at over 61%, and that's because of its huge bet on NVIDIA. But here's the most critical insight on this whole table. Look at SOXQ, our low-cost leader. It's right there, neck and neck, with almost identical performance. This tells you something huge. You don't have to overpay for top-tier returns. Meanwhile, the specialist, SMHX, has lagged a bit because its design-only focus missed out on some big gains from the manufacturers. The takeaway here is crystal clear. SOXQ gives you the best of both worlds, market-leading performance for a rock-bottom price. This chart here really says it all about SMH's strategy. It's aggressive. NVIDIA makes up almost 20%, a fifth of the entire fund. This is a super high conviction bet. It means that when NVIDIA is on a tear, SMH is going to outperform just about everything. But, it's a double-edged sword. The fund's fate is tied really, really closely to a single company, and that introduces some pretty serious concentration risk. Now, let's contrast that with SOXQ. It's a totally different philosophy. NVIDIA is still the top dog, as it should be, but it's at a much more moderate 11.4%. And the rest of the fund, it's spread out much more evenly among the other 29 giants of the industry. This approach gives you fantastic exposure to the sector's leader, but it does a much better job of managing that single stock risk. It's built for a smoother ride, which, frankly, is usually what you want for a core position in your portfolio. So you might be wondering, why on earth would we treat such a volatile sector as a core holding? Well, because the demand we're seeing isn't just a flash in the pan. We're talking about hundreds of billions of dollars in committed spending from the hyperscalers, the giants like Google, Amazon, and Microsoft. They're locked in an AI arms race, signing multi-year contracts to buy all the chips they can get their hands on. And all that spending flows directly into the pockets of the companies in these ETFs. And this spending, it really points to a fundamental long-term shift. Semiconductors are not just about the old boom and bust cycle of PC sales anymore. They are now critical global infrastructure. You've got demand coming from all sides at once. The massive AI build-out, the computer on wheels that is every electric vehicle, the government-backed push to bring manufacturing back home, and of course the relentless upgrade cycle for our phones and gadgets. These are powerful, overlapping tidal waves, all pushing the industry forward for years to come. And this really gets to the core of it, the main value proposition for an investor like you. An ETS like this gives you targeted, high-conviction exposure to what is, without a doubt, the single biggest growth story of our generation. Instead of tearing your hair out trying to guess the one winner between NVIDIA or AMD or Broadcom, you just own the whole winning team. It is simply the smartest, most efficient way to get direct exposure to this technological revolution. So, after weighing all the evidence, after looking at all the numbers, our verdict is in. For a core, long-term portfolio holding, the winner is SOXQ. The logic is just so simple and powerful. It gives you virtually the same exposure and the same top-tier performance as its bigger, more expensive rivals for almost half the fee. Over the long run, cost is king. Now, for our runner-up, we've got SMH. It's the perfect choice for active traders or for investors who really want to press their bet, who want the most concentrated exposure to today's winners and need that top-tier liquidity. Let's just quickly walk through our logic one more time just so it's crystal clear. Step 1, all 4 of these ETFs are a great way to ride the massive AI megatrend. Step 2, when you're investing for years, not days, cost is the most reliable, controllable advantage you have. Step 3, the data clearly shows that SOXQ delivers that premium exposure for the lowest fee in the entire category. And that leads us straight to step 4. SOXQ is our #1 pick for a core position in your portfolio. Now hold on. To be responsible investors, we have to talk about the risks, and you need to take these seriously. This is not some sleepy, low-risk investment. The semiconductor sector can have wild, gut-wrenching swings in the short term. There are constant geopolitical tensions, especially around Taiwan, which is home to the world's most important chip maker. Let's be honest, valuations are pretty high after the insane run-up, and even though we think this is a long-term trend, a major global recession could still hurt things. This is an investment that's really best for people with at least a 5 to 10 year time horizon.
And of course, I have to give our mandatory disclaimer. This content is not financial advice and it's not tax advice. It is for educational and informational purposes only. You should always do your own research and consult with a qualified professional before making any investment decisions.
So, the final question now goes to you. Based on your own goals and your own strategy, which team are you on? Are you on Team SOXX, playing the long game and prioritizing low costs? Or are you on Team SMH, going for maximum firepower right now? Let us know your pick down in the comments below. If you found this breakdown valuable, please do us a huge favor and subscribe, like, and share ValueVest Daily for more daily learning opportunities before you put your hard-earned money to work. We do deep dives like this every single week to help you become a smarter, more informed investor. And one more thing, please drop a comment if there are any specific high-risk, high-reward opportunities you want us to break down next. As you think about your next move, just remember, in a world that's literally being rebuilt on silicon, owning the builders might just be the best strategy of all. Thanks for watching.